Most people who invest their money lose to the market. Not because they're stupid, not because they picked the wrong stocks, but because they do too much. They check prices daily, they read headlines, they react, they trade, and every time they move, they bleed a little more. There's a different way. 3 rules, nothing else. No predictions, no timing, no genius required. And the uncomfortable part? It works better than almost everything else, but it requires you to do something most investors can't handle. Nothing. Let me show you why that's so hard. In 1976, a man named John Bogle launched the first index fund available to everyday investors. Financial experts called it un-American. They said it was designed for mediocrity. One competitor called it Bogle's folly. The fund didn't try to beat the market. It didn't employ brilliant analysts or chase hot stocks. It just bought everything and sat there. Today, that approach manages over $10 trillion. But here's what nobody mentions. Most people who use index funds still underperform them by a lot. Morningstar studied this. Between 2000 and 2020, the S&P 500 returned about 6% annually. The average investor in S&P 500 funds? 4%. Same funds, worse results. The difference wasn't the strategy, it was behavior. People bought high, sold low, jumped around, and bled returns every time they moved. So the question isn't what to invest in, that part's been solved. The question is, how do you invest in a way that protects you from yourself? That's what the 3-rule system does. Rule 1. Buy the whole market and nothing else. Not stock picks, not sector bets, not the hot AI company your cousin mentioned. The entire market weighted by size in one fund. This sounds obvious until you realize how violently it goes against human wiring. Your brain wants a story. It wants to believe you can spot the next Apple or avoid the next Enron. It wants to feel smart. Index funds offer none of that. They're boring. They're passive. They admit you don't know which companies will win. And that admission is the advantage. In any given year, about 80% of professional fund managers fail to beat the market. Over 15 years, that number climbs to 90%. These are people with teams, models, Bloomberg terminals, insider access, and they lose. Not because they're incompetent, because the market is efficient enough that the cost of trying to beat it, trading fees, research expenses, taxes, eats the edge. You're not smarter than them, neither am I. So rule 1 is a surrender. You give up the possibility of being a hero. In exchange, you get something more valuable. You stop being the villain in your own story. You own everything. Tech, healthcare, energy, banks, utilities. When one sector crashes, another holds. When the market grows, you grow. You don't have to predict anything. The fund that does this best is boring by design. Low fees, no manager, just a mirror of the market. Most people can't accept this. It feels like giving up. But it's not giving up. It's opting out of a game you were never going to win. Rule 2, invest the same amount every month, no matter what. Same day, same amount. Market up, market down, recession, boom, doesn't matter. You move money in like clockwork. This is called dollar cost averaging, and it's the only timing strategy that removes timing from the equation. Here's why it matters. Imagine it's March 2020. The market just crashed 30% in 3 weeks. Your portfolio is bleeding. Every headline says it's going to get worse. Your family is scared. Your gut says, stop, wait, let this settle. If you stop, you miss the bottom. The market rebounds 50% over the next 5 months. The best buying opportunity in a decade. Gone, because you blinked. Now imagine it's late 2021. Everything's up. Bitcoin's at 60,000. Your neighbor just made a fortune on Tesla. FOMO is everywhere. You think, I should invest more, catch the wave. If you do, you're buying at the peak. 12 months later, you're down 20%. Timing the market requires 2 perfect decisions, when to get out and when to get back in. Most people get one right if they're lucky. Nobody gets both right consistently. Dollar cost averaging doesn't try. It buys high, it buys low. It averages out the noise. And there's a psychological edge here that's just as important as the math. When the market crashes and you keep investing, you're training yourself to see fear as opportunity. You're buying stocks on sale. Over time, that reframes the whole experience. Crashes stop feeling like disasters. They feel like discounts. This only works if the amount is automatic. If you have to decide each month, you'll find reasons to skip. You'll optimize. You'll wait for a better moment. The system dies the second you start thinking. Rule 3, don't touch it for decades. Not years, decades. This is the rule that breaks most people, because the market will try to shake you out. It'll drop 20%, then 30%. It'll stay down for months. You'll watch your account shrink and think, this isn't working. Maybe I should move to cash. Maybe I should wait for things to stabilize. If you sell, you lock in the loss. And worse, you'll almost certainly buy back in after the recovery starts, which means you sold low and bought high, the exact opposite of the goal. Here's the part that makes this so hard. The market is wrong most of the time. Between 1928 and 2023, the S&P 500 spent about 70% of all days below its all-time high. 70%. For most of history, if you checked your account, it looked like you were losing or treading water. But over that same period, the market returned about 10% annually. A dollar in 1928 became over $300,000 by 2023. The returns didn't come from calm, steady growth. They came from explosive bursts, usually right after crashes, when everything felt the most broken. If you missed just the 10 best days in the market over the last 30 years, your returns would be cut in half. 10 days out of more than 7,000. You don't know when those days will happen. Nobody does. They often come in the middle of chaos. September 2008, the height of the financial crisis, had one. March 2020, peak pandemic panic, had 3. If you're out of the market, waiting for safety, you miss them. This is why Rule 3 matters. Time in the market beats timing the market. Not because you're smart, but because you're present. The system doesn't require you to believe the market will go up next month or next year. It requires you to believe that over 30 years, human enterprise will create more value than it destroys. That's it. That's the bet. And historically, that bet has paid off every single time, as long as you didn't panic and leave early. Let's put some numbers on this. Say you're 30 years old. You invest $500 a month. The market returns 8% annually, which is slightly below the historical average. By 65, you have just under $900,000. Now let's say you do the same thing, but you panic twice. Once in a recession, you pull everything out and wait 6 months before getting back in. Another time, you see a crash coming, or you think you do, and you move to cash for a year. Those 2 mistakes, 18 months out of 35 years, cost you about $200,000. You were right to be scared. The market did crash, but you still lost because you moved. Here's the darker version. Say you invest the same $500 a month, but instead of an index fund, you pick stocks. You're decent at it, you beat the market some years, but you also pay more in fees, you trade more often, you trigger taxes, and you miss a few big runs because you are in the wrong names. Your average return drops to 6%. By 65, you have $550,000. $350,000 less than the boring, mindless index approach. You worked harder. You were more engaged. You lost. This is the uncomfortable truth at the center of the 3-rule system. Effort doesn't correlate with results. Often it's inversely correlated. The more you try, the worse you do. The system works because it removes decision points. No stock picks, no timing calls, no emotional exits. Just a machine that runs in the background while you live your life. And that's what most people can't stomach. It feels too passive, too simple, like you're not doing enough. But that's the point. Of course, this isn't perfect. The system assumes you can afford to invest every month. If you're living paycheck to paycheck, Rule 2 is irrelevant. You need a different strategy, one focused on building stability first. It also assumes you don't need the money for decades. If you're 55 and retiring at 60, you can't ride out a crash. You need bonds, cash, safety. and it assumes the future looks something like the past, that markets will continue to grow over long periods, that capitalism won't collapse, that the US economy won't permanently stagnate. Those aren't crazy assumptions, but they're still assumptions. There's also a psychological cost. Following this system means watching your friends get rich on crypto or meme stocks while you sit in your boring index fund. It means enduring crashes without doing anything. It means ignoring financial news because most of it is noise designed to make you trade. That's harder than it sounds. The three-rule system doesn't promise to make you rich quickly. It doesn't even promise to make you rich. It promises to give you the market's average with the least amount of self-sabotage. For most people, that's enough. The market's average return, compounded over decades, builds serious wealth. But it requires patience in a world that rewards speed. It requires humility in a culture that celebrates bold calls. And it requires you to accept that the best investing strategy feels like you're not doing anything at all. So here's the system. Buy the whole market, invest the same amount every month, don't touch it for decades. 3 rules. No exceptions. It won't make you feel smart, it won't give you stories to tell at parties, but it will quietly compound in the background while everyone else is guessing. The irony is that the investors who do the best are often the ones who forget they're even invested. The account sits there untouched, growing while they focus on their careers, their families, their lives. They're not heroes, they're not geniuses, they just didn't get in their own way. And maybe that's the real question. Can you build a system that protects you from yourself? Can you set it up so that doing nothing is the default and doing something requires effort? Because in investing, the most dangerous person you'll ever face isn't the market. It's you.